This CTA screencasting project is supported by the South African Institute of Chartered Accountants and the Auditor General of South Africa via the Tutuka program. It is important to note that IFRS 15 is a new standard that replaces the following old standards and interpretations: IAS 11, IAS 18, IFRIC 13, IFRIC 15, IFRIC 18, and SIC 31. IFRS 15 establishes principles for reporting useful information to users of financial statements about the nature, amount, timing, and uncertainty of revenue and cash flows arising from an entity's contract with customers. As part of discussing IFRS 15, I will focus on the 5-step revenue model. Each step will represent a separate screencast. The first screencast will be the first step of the revenue model. Identify the contract or contracts with the customer. The second screencast will be the second step of the revenue model. Identify the performance obligations in the contract. The third screencast will be the third step of the revenue model. Determine the transaction price. The fourth screencast will be the fourth step of the revenue model. Allocate the transaction price to the performance obligations. The fifth screencast will be the fifth step of the revenue model. Recognize revenue as or when the entity satisfies a performance obligation. Let's start with the first step of the revenue model. Identify the contract or contracts with the customer. What is a contract in terms of IFRS 15? A contract is defined as an agreement between two or more parties that creates enforceable rights and obligations. What is a customer in terms of IFRS 15? A customer is a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. An entity shall account for a contract with a customer within the scope of IFRS 15 only when all of the 5 following criteria are met. The parties to the contract have approved the contract, either in writing, orally, or in accordance with other customary business practices, and are committed to perform their respective obligations, and the entity can identify each party's rights regarding the goods or services to be transferred, and the entity can identify the payment terms for the goods or services to be transferred, and the contract has commercial substance. When will the contract have commercial substance? When the risk, timing, or amount of the entity's future cash flows is expected to change as a result of the contract. And lastly, it is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. In evaluating whether the collectibility of an amount of consideration is probable, an entity shall consider only the customer's ability and intention to pay that amount of consideration when it is due. A contract does not exist if each party to the contract has the unilateral enforceable right to terminate a wholly unperformed contract without compensating the other party or parties. The contract is a wholly unperformed contract if both of the following criteria are met. Firstly, the entity has not yet transferred any promised goods or services to the customer, and the entity has not yet received and is not yet entitled to receive any consideration in exchange for promised goods or services. When consideration is received from a customer and the 5 criteria for recognition of the contract have not been met, what should the credit leg of the journal entry be recognized as? An entity shall recognize this consideration received from a customer as a liability. It shall only be recognized as revenue when the 5 recognition criteria are subsequently met, or when one of the following events have occurred. The entity has no remaining obligations to transfer goods or services to the customer, and all or substantially all of the consideration promised by the customer has been received by the entity and is non-refundable, or the contract has been terminated and the consideration received from the customer is non-refundable. A contract modification is a change in scope and/or price approved by parties to the contract. The modification is accounted for as a separate contract if the scope increases due to additional distinct goods or services promised, When goods or services are deemed distinct will be discussed as part of screencast 2. And the price of the contract increases by an amount equal to the standalone selling prices of the additional goods or services, and any appropriate adjustments to that price to reflect the circumstances of the particular contract. For example, a discount may be granted to an existing customer due to savings in selling-related costs. If it does not meet the requirements to be accounted for as a separate contract, you need to determine if the remaining goods or services of the original contract are distinct from the goods or services already transferred to the customer before the modification of the contract. If it is distinct, it is accounted for as a termination of the existing contract and the creation of a new contract. If it is not distinct, it is accounted for as if the modification is part of the existing contract. Now let's do an example. A real estate developer enters into a contract with a customer for the sale of a building for $1 million. The customer intends to open a restaurant in the building, in an area where new restaurants face high levels of competition and the customer has little experience in the restaurant industry. The customer pays a non-refundable deposit of $50,000 at inception of the contract and enters into a long-term financing agreement with the entity for the remaining 95% of the promised consideration. The financing arrangement is provided on a non-recourse basis, which means that if the customer defaults, the entity can repossess the building, but cannot seek further compensation from the customer, even if the collateral does not cover the full value of the amount owed. The customer obtains control of the building at contract inception. What is required? Firstly, does a contract exist in terms of IFRS 15? And secondly, how should the non-refundable deposit of $50,000 be recognized? Let's start with the first part of the required. Does a contract exist in terms of IFRS 15? All 5 criteria of IFRS 15 has to be met in order to recognize a contract. The contract has been approved by the parties through a signed agreement. Each party's rights to goods or services can be identified. The entity must transfer a building to the customer. The payment terms can be identified. The customer needs to pay $1 million, $50,000 upfront as a non-refundable deposit, and the remaining balance is financed through an agreement with the entity. The contract has commercial substance. Risk, timing, and amount of future cash flows are expected to change. The customer intends to repay the loan from income derived from the restaurant business, which faces significant risks due to high competition and limited experience. Secondly, the customer lacks other income or assets that could be used to repay the loan. And finally, the customer's liability in terms of the loan is limited as it is non-recourse. To conclude, all 5 criteria are not met and thus a contract does not exist, as it is not probable that the entity will collect the consideration it is entitled to in exchange for the building. All 5 criteria has to be met. Let's address the second part of the required. How should the non-refundable deposit of $50,000 be recognized? The 5 recognition criteria for a contract are not met, and thus the non-refundable deposit of $50,000 should be recognized as a liability. In terms of IFRS 15 paragraph 15, it can only be recognized if one of 2 events occur. The entity has no remaining obligations to transfer goods or services to the customer, and all or substantially all of the consideration promised by the customer has been received by the entity and is non-refundable. This event, however, has not occurred, as the entity has an obligation to transfer the building to the customer, and not all of the promised consideration has been received. The second event, the contract has been terminated and the consideration received from the customer is non-refundable. This event also has not occurred, as the contract has not been terminated. To conclude, the deposit of $50,000 should be recognized as a liability and not as revenue. The illustrative examples number 1 to 9 in Part B of IFRS 15 provides additional examples on Step 1 of the revenue model, identifying the contract or contracts with customers. In the next screencast, I will discuss the second step of the revenue model, identifying the performance obligations in the contract. Thank you for your time and good luck in your preparation for the test.